Money, Credit, and Crises. Understanding the Modern Banking System. Mikhail Nektorios. Part 1. A History of Banking 1. A brief history of money and credit. Definition and purpose of money. Money is a tool used in daily transactions but is often not deeply considered. Historically, various forms of money have been used, each evolving with human society and trade. Functions of money. Money serves four essential functions. 1. Medium of exchange, facilitates transactions and is accepted by all involved parties. 2. Standard of payment, provides a standard for deferred payments, ensuring that the value of the transaction remains consistent over time. 3. Measure of value, allows for the comparison of the value of different goods and services. 4. Store of wealth, preserves value over time, enabling savings and future transactions. Historical forms of money. Many items have served as money, including paper, metal, gold, silver, copper, and even commodities like tobacco or cattle. Barter systems, where goods were directly exchanged, preceded the use of money but had limitations, particularly in ensuring equitable exchanges over time and with strangers. Credit as a form of money. Credit can be considered an early form of money, where trust in repayment acted as a means of exchange. However, relying solely on credit posed risks, particularly in larger or less familiar communities, leading to the development of more reliable forms of money. Bartering and its limitations. Bartering involved direct exchanges but was limited by the need to find someone who wanted what you had and had what you wanted. It also introduced challenges in dividing goods like livestock and dealing with perishable items, leading to inefficiencies in trade. Development of durable money. To address these limitations, money needed to be durable, universally accepted, and stable in value over time. Metals like gold and silver became prominent due to their durability, divisibility, and relative scarcity, which provided a stable value. Sovereign guarantees and universal acceptance. The effectiveness of money is enhanced by a sovereign guarantee, making it universally accepted within a nation. Even without state backing, items like gold retain their value due to universal recognition and limited practical uses, making them excellent stores of wealth. Gold as a standard. Gold's lack of practical applications outside of money, except for minor industrial uses, made it a reliable standard for transactions. Its durability, resistance to oxidation, and divisibility made it a preferred form of money for centuries. Early banking and standardization. In ancient Babylonia, as trade expanded, the need for standardized money grew, leading to the prominence of gold and silver. Early forms of banking emerged, with trusted individuals or institutions safeguarding precious metals, charging fees for this service. Loans and interest-bearing deposits became common, with contracts drawn up to formalize these transactions, leading to more sophisticated financial systems. Introducing coins. 7. Gold and silver bullion. Historically, money referred to the use of gold and silver in unprocessed or minimally processed forms for transactions and storage. Introduction of coinage. Around 650–600 BC, Lydia became the first state to mint standardized gold and silver coins using electrum, marking the coins as official legal tender. Impact on banking. Early banking, focused on safekeeping and some lending, was minimally affected by the introduction of coins. Banks offered returns on deposits and provided various financial services, though they constituted a small fraction of total loans. Confidential banking in Athens. Athenian bankers kept transactions confidential, which could undermine public trust in banking. Lack of comprehensive records meant bankers faced little financial risk. Roman banking innovations. Roman bankers began converting foreign currencies and were among the first currency exchangers. Public bankers were appointed to manage citizens' debts. Challenges with precious metals. The use of gold required precise weighing and assaying to ensure its value, leading to risks of counterfeiting and inaccuracies in transactions. Banking in the Middle Ages. 8. International trade played a key role in the transition from specie, bullion, to representative, paper, money. Paper money originated in China during the 10th century AD, influenced by merchant receipts of deposit from 600 to 900 AD. Marco Polo introduced paper money to Europe in the 13th century. Promissory notes, used by merchants to avoid carrying heavy coins, had earlier versions in ancient Rome and Carthage. Paper money was initially backed by deposits of gold or silver. Trust in the authenticity of coins was challenging, leading to the rise of depositary institutions, especially in medieval Italy. Representative money, essentially certificates of gold or silver deposits, became popular as larger transactions emerged. Medieval banks expanded beyond storage and coin transfer to include services like payment orders, similar to checks. Deposit banking mitigated risks associated with coin issuance, storage, and counterfeiting, facilitating trade. Depository banks helped alleviate the scarcity of money by allowing ownership transfer without the need for physical coins. Due to religious bans on usury, medieval banks often engaged in equity participation rather than lending with interest. Banks also engaged in non-commercial lending, often to princes and nobles, secured by collateral like jewelry. Guarantors were used when borrowers lacked collateral, with forward contracts used to avoid usury. Medieval banks were heavily involved in state financing, sometimes securing loans with tax or customs revenue. Discounting receivables, guarantees, and buying-selling options on public debt were common practices. Banks faced liquidity and risk issues, resorting to practices like fractional reserve banking to manage sudden withdrawals. External factors like war, coin shortages, and agricultural cycles posed challenges to banking operations. Deposit banks were heavily regulated due to their role in currency management and trade facilitation. Banking access was restricted, requiring licenses or guarantees, and bank failures led to severe penalties, including personal liability and even execution. Merchant banking. The rise of international trade led to the emergence of merchant banks in Italy during the 11th century. Large trading companies established branches across regions, facilitating fund transfers for other merchants and becoming merchant bankers. Merchant banks capitalized on exchange rate differences through arbitrage, maintaining market liquidity and manipulating exchange rates. Due to the time lag between fund acceptance and payment, merchant bankers benefited from what was essentially a free loan, which they could lend to third parties. Merchant bankers offered lower interest rates than ordinary merchants, making lending cheaper and more accessible. This process broke the traditional link between sales and credit, allowing merchants to buy goods with borrowed money, boosting the money market for short-term loans. Sovereigns also borrowed from money markets to solve short-term liquidity issues, often on favorable terms for lenders. Merchant banks not only financed trade but also traded in commodities like wool, cloth, wine, lead, and horses, taking advantage of their market presence and information. The failure of Siena's Gran Tavola in 1298 led to the dominance of Florentine merchant bankers in Europe. Merchant banks focused on liquidity management, matching the maturity of assets with liabilities, and avoided long-term lending. Merchant bankers were personally liable for losses, leading them to set up each branch as a separate partnership to insulate against risks. Crises, especially related to sovereign lending, led merchant banks to reduce sovereign lending and governments to seek alternative financing methods. The rise of public banks. By the mid-15th century, Europe experienced a wave of deposit bank failures due to a bullion famine that constrained liquidity. Deflation and economic slump exacerbated bank failures, increasing demand for coins and worsening the shortage. Venice reported that out of 103 private banks, 96 had failed by the 16th century, prompting the creation of the Banco di Rialto in 1587, a non-lending payments institution. Other cities, like Barcelona, had public banks like the Taula, which funded government debt but faced challenges with overlending, leading to payment suspensions. Public banks became more stable and efficient than private banks, eventually dominating European deposit banking by the 17th century. The Renaissance saw the rise of exchange banks, notably the Amsterdam Wisselbank in 1609, which addressed issues like Gresham's law by valuing deposits based on metal content, not face value. The Wisselbank became highly successful, offering secure, stable bank money and reducing the need for physical coin transactions. The Wisselbank also introduced an overdraft facility by 1657, though secrecy around it led to a loss of public confidence by 1790, eventually causing the bank's insolvency. The Wisselbank is considered an early archetype of central banking, despite initially focusing on better minting practices rather than creating central bank money. Sweden's Stockholm's Banco issued the first credit notes not tied to deposits in 1661, but overcreation of notes led to its collapse by 1664, though the concept influenced future central banking developments. Goldsmith banks and the Bank of England 19 in early 17th century London, goldsmiths expanded their services beyond metalworking, becoming creditors by exploiting discrepancies in coin weights and values. By 1660, goldsmiths had become the largest debtors in London, accepting bills of exchange and issuing notes backed by these bills. Goldsmiths introduced bearer clauses in their notes, transforming banking by making the notes payable to whoever presented them, removing the original debtor from liability. Goldsmiths' notes included a demand clause, allowing note holders to demand payment anytime, creating the first instances of fractional reserve banking. Fractional reserve banking allowed goldsmiths to create money by issuing more notes than they had in reserves, effectively creating credit out of thin air. This system relied heavily on trust in the goldsmiths, but it was prone to failures if the goldsmiths could not meet their obligations, leading to the need for a more stable system. The Bank of England was established in 1694 to act as the government's banker, raising funds at a lower cost for the government and displacing goldsmith bankers. The Bank of England was granted a monopoly on issuing notes in London by 1709, making its notes legal tender and marking the shift from private to public banking. The success of the Bank of England inspired other countries, like France with the Banque de France in 1800, to create central banks to improve war financing. The central banking model, pioneered by England, eventually gained wider acceptance, though some countries like the US initially resisted adopting it. Economic history is filled with numerous financial crises, but not all have significantly impacted the banking sector's evolution. The chapter focuses on banking crises from the 20th and 21st centuries that led to significant regulatory changes, especially in developed economies. The Panic of 1907 in the US was a pivotal crisis that reformed the banking sector and led to the creation of the Federal Reserve. The crisis began with E. Augustus Heinz's failed attempt to corner the market for United Copper stock, leading to bank runs due to fears of insolvency. The crisis was exacerbated by seasonal liquidity issues in New York and international gold flows influenced by U.S. policy. The New York Clearinghouse intervened, demanding the resignation of key figures like Heinz and Morse, and provided financial support to stabilize the banks. The panic extended to trust companies, particularly Knickerbocker Trust, leading to further runs. J.P. Morgan played a crucial role in managing the crisis by channeling funds to distressed trusts and the stock market, supported by the U.S. Treasury. The absence of a central bank during the crisis highlighted the need for a formal mechanism to provide liquidity, leading to the eventual creation of the Federal Reserve in 1913. The Panic of 1907 is remembered as a significant event that fundamentally changed the U.S. financial landscape, influencing central banking policy for decades. The post-1907 period remained stable until World War I, which disrupted economies due to heavy debts and a return to the gold standard, causing further financial instability. The Great Depression 1927 show a financial crisis in Japan, originated after post-WWI business boom, companies overinvested, creating a bubble. The Great Kanto earthquake of 1923, killing over 140,000, exacerbated the economic depression. Government issued earthquake bonds to support banks, leading to bank runs when rumors spread about bond redemption. Resulted in 37 bank bankruptcies, consolidating power in zaibatsu conglomerates. Crisis resolved through a 3-week bank holiday and emergency loans by the Bank of Japan. The crisis went largely unnoticed globally due to Japan's currency being pegged to the dollar, not gold. Great Depression, 1929 to 1933 began with a stock market crash on October 29, 1929, following a speculative bubble. Dow Jones lost 19.5% in October and 21.5% in November 1929, with a total market value loss of over 37%. Bank lending to brokers doubled from 1924 to 1929. Margin requirements were only 10%, leading to massive liquidation and further market damage. Credit boom of the 1920s doubled bank lending, with real GDP growth of 60% and stock market value more than doubling. The speculative orgy and subsequent stock price bubble were well documented, with early warnings from figures like Paul Warburg. 1929 saw 32% increase in bank suspensions, doubling to 1,350 in 1930. Large depositor losses due to liquidity shortages. Bank failures and feedback loop. Bank failures due to stock market losses led to deposit runs, causing more failures. Unwillingness of banks to lend and public reluctance to borrow further contracted the economy. Irving Fisher's debt deflation theory, 1933, explained how falling asset prices and debtor bankruptcies created a deflationary spiral. Federal Reserve and policy failures. Federal Reserve's response was inadequate, with mild interest rate reductions having little effect. Fed failed to act as lender of last resort, leading to nearly 10,000 bank suspensions from 1929 to 1933. Belief in laissez-faire and adherence to the gold standard, along with the real bills doctrine, led to policy inaction. Fed's excess reserves increased dramatically, reflecting banks' reluctance to lend. Gold standard and global speculation. U.S. adherence to gold standard limited monetary policy, leading to speculative attacks on the dollar after Britain abandoned gold in 1931. Fed's increase in discount rate worsened the recession, leading to more bank failures. Hoover administration's fiscal policy. Hoover maintained a surplus budget in 1929 to 1930, with only minimal deficits in subsequent years.
The Revenue Act of 1932, raising taxes, worsened the economic situation.
Roosevelt's New Deal and economic recovery. Roosevelt's Emergency Banking Act, March 1933, closed all banks, issued emergency currency, and led to the recovery of public confidence. The Gold Reserve Act, 1934, increased the gold price, contributing to monetary expansion and economic recovery. M1 money supply grew by 10% annually from 1933 to 1937. GNP grew by 8% annually, ending the Depression. Impact of the Great Depression. Real output dropped by 26.5% during 1929 to 1933, the largest contraction in U.S. history. Unemployment peaked at 25.5% in 1933. International trade shrank by over 60% due to the Smoot-Hawley tariff and global trade barriers. Economic output recovered to 1929 levels by 1937. Unemployment only returned to pre-depression levels with the onset of World War II in 1941. The Global Depression. 43 Global impact of the Great Depression. The Great Depression differed from previous crises due to its global reach, severely affecting countries adhering to the gold standard. Countries like Australia, Canada, France, and Germany were significantly impacted, with varying degrees of economic decline and recovery. Australia, severely hit by the Great Depression, with effects lasting until World War II. Unemployment was already high before the U.S. crash, 10% in 1929, and peaked at 32% in 1932. Australia was under pressure from Great Britain to meet international loan obligations, leading to severe wage cuts. The Premier's Plan, 1931, implemented deflationary measures. 20% cuts in spending, wages, increased taxes, and reduced interest rates. Recovery began in 1932, driven by Australia leaving the gold standard in 1931, which devalued the currency, and a slow recovery in international wheat and wool prices. Canada's economic downturn was as severe as the US, with real output dropping by 28% and prices falling by 15% by 1933. Exports dropped to one-third of their 1928 peak. The Canadian government took no significant monetary action initially. The advance rate remained unchanged at 4.5% from 1928 to 1931. Banks reduced lending and quickly repaid government borrowings, leading to a monetary contraction and a rise in the Canadian dollar's value. The advance rate was later reduced to 3% in 1931 and 2.5% in 1933, but the Canadian dollar's temporary depreciation was countered by Roosevelt's gold policies. Distrust in banks and high nominal and real interest rates led to the establishment of the Bank of Canada in 1935. Despite this, Canada's economy did not recover to 1929 levels until World War II in 1939. France was less severely affected by the Great Depression compared to other countries, with a 13% decline in output by 1936. Employment fell by 10% by 1936, with a slow recovery beginning thereafter. France, along with the US, was a key driver of global monetary tightening due to its large gold reserves, 20% by 1930. Both countries' policies of gold sterilization forced other countries to tighten their monetary policies, worsening the global economic environment. France's adherence to the gold standard led to a recessionary spiral, contributing to the lead-up to World War II. Germany. The Great Depression in the US had a severe impact on Germany, which was already burdened by World War I reparations, 132 billion gold marks. The Dawes Plan, 1924, provided temporary relief but was undermined by the financial crisis as American banks withdrew loans, leading to soaring unemployment, 33.7% in 1931, 40% in 1932. The Hoover Moratorium, 1931, attempted to pause reparations but had little effect. Germany's situation improved after leaving the gold standard, easing reparation payments, Young Plan, 1931, and imposing exchange controls. Fiscal policy, especially military spending, played a significant role in reducing unemployment, which dropped below 12% by 1935. Japan, similar to Germany, Japan used expansionary fiscal policy, primarily focused on military expenditure, to recover from the Depression. While fiscal expansion helped, the problematic cause, militarization, led to World War II, which ultimately revived global economies. Introducing deposit insurance. 46 Global impact of the Great Depression. One of the key characteristics of the Great Depression was the widespread occurrence of bank runs. Bank runs stemmed from depositors' fear of losing their money due to bank failures, which was supported by evidence of significant losses for depositors in insolvent banks. Roosevelt's measures. In his radio address, Roosevelt assured the public that deposits in banks reopening on Monday would be safe, but this was only a temporary measure. The measure was prone to future bank failures and potential bank runs. Banking Act of 1933 introduced a temporary plan to insure all deposits up to $2,500 for Federal Reserve member banks. In 1934, the coverage was extended to $5,000, and the plan was made permanent with the Banking Act of 1935. The 1935 Act also included non-member banks with average deposits over $1 million by 1941, forcing them to join by July 1942. Deposit insurance funding. Banks were required to pay 1/12% of average total deposits to fund the insurance plan. The flat rate meant depositors at riskier banks received the same protection as those at conservative banks, an issue of importance in later crises. Rationale for deposit insurance. The purpose was to protect ordinary depositors who may not understand or monitor their bank's financial health. Deposit insurance aimed to prevent panic during bank failures and safeguard depositors' savings. Global adoption of deposit insurance. Deposit insurance became popular globally, with 59% of countries adopting explicit deposit insurance by the end of 2013. The adoption rate was 84% in high-income countries and 96% in European countries. 88% of countries with deposit insurance use a scheme similar to the ex-ante model from the 1935 Act. Expansion post-2008 financial crisis. The number of countries with deposit insurance rose from 84 in 2003 to 112 in 2013, with 14 countries adopting it after the 2008 financial crisis. Almost all countries with deposit insurance increased coverage limits after the crisis. Deposit insurance has been effective in preventing systemic bank runs, with only isolated incidents occurring during the late 2000s recession. Bretton Woods. 47 Post-WWA monetary cooperation. Allied forces sought to create a new international monetary system after World War II, leading to the United Nations Monetary and Financial Conference in July 1944 at Bretton Woods, New Hampshire. Despite public and policymaker attachment to the gold standard, most recognized that effective ties to gold had been repealed. Bretton Woods System, 1944 established a blueprint for the post-war international monetary system, promoting free convertibility of currencies at a fixed, pegged, exchange rate, adjustable within a 1% band. Allowed countries to devalue up to 10% without consultation during fundamental disequilibrium. The US dollar was fixed to gold at $35 per ounce. Role of the IMF. The International Monetary Fund, IMF, was established in December 1945 to facilitate exchange rate stability and allow for the transfer of gold and currencies to support countries with current account deficits. The US controlled 3/4 of the world's gold reserves, making a US current account surplus undesirable as it would lead to a depletion of global reserves. Problems with Bretton Woods. The US was in a surplus from 1954 to 1971, causing concern about the sustainability of the fixed exchange rate with gold. US policies focused on full employment made it difficult for the Federal Reserve to raise interest rates, a traditional method to counteract declining gold reserves. The US's status as a reserve currency allowed it to live beyond its means, importing goods, buying foreign companies, and engaging in military adventures. Foreign countries were uncomfortable with the dollar's devaluation risks, despite the benefits of holding dollar reserves. Gold pool and two-tier gold market. The gold pool was created in 1961 to stabilize the price of gold at $35 per ounce, but it collapsed as non-US countries refused to share the losses. A two-tier gold market emerged in London, one for private transactions at market prices and another for official transactions at $35 per ounce. By 1968, central banks stopped buying and selling gold on the open market, shifting the Bretton Woods system from a gold standard to a dollar standard. Collapse of Bretton Woods, currency devaluations and rising U.S. budget deficits increased concerns about the viability of Bretton Woods. The 1970 recession led to a drop in interest rates, a flight of capital, and an increase in U.S. foreign liabilities. Inflation abroad soared as countries received large inflows of dollars, leading to currency floats by Germany, Canada, and other countries. The Nixon administration closed the gold window in August 1971, ending the exchange of dollars for gold and marking the collapse of Bretton Woods. Implications of Bretton Woods collapse. The collapse of Bretton Woods did not alter the global order but shifted the official dollar exchange to an unofficial one with floating exchange rates. The end of Bretton Woods marked the removal of capital controls and a new era of money creation unconstrained by exchange rate pegs or gold reserves. The U.S. continued to benefit from the dollar as a reserve currency, allowing it to live beyond its means and influence global financial stability. The reserve currency status implies that financial distress in the reserve country, e.g., the U.S., can have global repercussions, impacting both export-led economies and developed countries invested in the reserve country. The secondary banking crisis in the UK. 51 UK's secondary banking crisis, 1973 to 1975, marked the end of early cases of financial instability worldwide and was the first characterized by significant drops in real asset prices in the 20th century. The crisis was rooted in the macroeconomic policy shift in 1971 towards economic expansion, making finance readily available to stimulate investment. The dry-up of new projects in the 1960s, especially in office space, led to sharp rent increases, driving credit towards the property sector. Secondary banks. The fringe secondary banks were financial institutions that received deposits and granted loans but were not recognized as main banking institutions. They operated with fewer regulatory restrictions and focused on consumer credit and personal loans, often secured by second mortgages. In 1972, when authorized banks were discouraged from investing in property, secondary banks stepped in, funding themselves through money markets. Economic deterioration. In 1973, the depreciation of sterling led the Bank of England to raise the minimum lending rate to 11.5% in July and 13% by November 1973. A special deposit scheme imposed penalties on interest-bearing liabilities in wholesale money markets, exacerbating the funding problems of secondary banks. London and County Securities faced trouble in November 1973 as it could not renew deposits from money markets, signaling a broader crisis in the sector. Bank of England's response. The Bank of England quickly established the Lifeboat Committee to identify and support troubled deposit-taking institutions. Support was provided if the company was solvent, had sufficient banking characteristics, and shareholders couldn't provide liquidity. By March 1974, 21 institutions required liquidity support, with 17 receiving it. Total advances amounted to nearly £400 million. Collapse of property prices and increased support. By early 1974, property prices collapsed, further deteriorating the assets of supported companies. Total support required increased to £1.2 billion, 40% of the capital and reserves of the English and Scottish clearing banks. The Bank of England had to provide additional funds, with support reaching £1.285 billion by March 1975. Recovery and regulatory changes. From 1975, the situation improved, and lifeboat support was reduced to half of its peak. The Bank of England extended supervisory arrangements, and legislation passed in 1979 regulated deposit acceptance and enhanced control over deposit-taking institutions. End of an era and new norms. The crisis marked the end of the let-them-be approach from the Great Depression, with liquidity injections becoming the new norm. The global economic and financial landscape was changing, with the 1971 Nixon shock ending the gold-dollar connection. The increased role of investment banks and securitizations in the 1970s and 1980s shifted focus from overlending in securities to property investment. Part 2: How Banking Works. 3 Money and Inflation. Post-gold standard inflation surge. The U.S. experienced a significant rise in inflation after abandoning the gold standard, with inflation rates exceeding 4% in 1971 and averaging 7.2% throughout the 1970s. The inflation persisted until Paul Volcker, the Federal Reserve Chairman, raised interest rates to unprecedented levels to control it. Understanding inflation. Inflation is defined as the rate at which the general price level of goods and services changes, and it can be positive, inflation, or negative, deflation. Inflation impacts purchasing power. A 5% increase means consumers can buy 5% less with the same amount of money unless wages rise accordingly. Price change examples. Inflation is an average measure. Individual goods can vary significantly in price changes. Substitution between goods, e.g., apples and oranges, can influence inflation rates depending on price changes and consumer preferences. Inflation's causes. Inflation is influenced by supply and demand dynamics. Lower supply or higher demand increases prices, while higher supply or lower demand decreases them. Changes in purchasing power and consumer preferences are key demand factors. Technological advancements influence consumer preferences, often aligning them with newer technologies. Money supply and inflation. An increase in money supply typically leads to higher demand and inflation. Government deficit spending can increase inflation by injecting previously unused money into the economy, even though the overall money stock remains unchanged. Government surpluses and inflation. Budget surpluses, where government spending is less than its income, tend to lower inflation by reducing demand. The overall money supply remains unaffected by whether the government runs a surplus or deficit, but inflation is influenced by both. Inflation expectations. Rational expectations suggest that government spending increases must be perceived as permanent to affect inflation significantly. Increased government spending can boost GDP, leading to higher private sector investment and consumption, which may raise inflation without needing tax increases. Foreign capital inflows and inflation. Foreign direct investments increase local money supply and purchasing power, potentially raising inflation. The impact of foreign deposits on inflation depends on how banks use the extra liquidity, whether for lending or retaining reserves. Trade and inflation. Exports increase money supply and purchasing power domestically, while imports reduce them. Price increases in imports, e.g., oil, can drive domestic inflation by raising production costs for local firms. Hyperinflation. Hyperinflation is often triggered by severe supply shocks and significant disruptions, as seen in historical examples like the Weimar Republic and Zimbabwe. Hyperinflation results from a loss of confidence in the national currency, exacerbated by government spending, exchange rate depreciation, and rising wages and import prices. Inflation during supply shocks. Supply-side disruptions, such as the 1970s oil embargo, can lead to inflation by reducing production capacity. The US experienced increased inflation due to a significant drop in capacity utilization during the oil embargo, which was later eased by price stabilization and supply-side reforms under Reagan. Supply-side economics. Reagan's supply-side reforms highlighted the importance of addressing specific economic issues rather than relying on one-size-fits-all policies like Keynesian deficit spending. During demand-driven recessions, supply-side reforms are less effective, as they require existing demand to be successful. Inflation and economic growth. A stable money supply and demand would result in zero economic growth. Growth requires increased production and demand, which in turn causes inflation. Milton Friedman and monetarists argue that inflation results from the difference between money supply growth and output expansion. Inflation's sad reality. Inflation is inevitable unless supply increases exactly match demand increases, which is highly unlikely. Stable inflation is crucial for economic stability, as significant price fluctuations can disrupt production and trade. Controlling demand to manage inflation. Central banks manage inflation by controlling demand through interest rate manipulation, making investments less attractive and borrowing riskier. This fine-tuning approach affects the economy but does not fundamentally alter it. For money and banking gold standard era, money supply was controlled by the amount of gold in the economy. Increasing gold led to an increase in money supply, and vice versa. Post-gold standard, central banks could issue new money, increasing the monetary base, money printing. After the Nixon shock, currency in circulation increased significantly, particularly post-1981. Banking sector and money creation. Banks create money through the process of issuing loans, not just by redistributing deposits. Modern banks credit a customer's account with a deposit matching the loan amount, simultaneously creating a liability, the loan obligation. Loan repayment decreases money supply by reducing both the deposit and loan liability. Bank balance sheets. Upon creating a loan, banks simultaneously create an asset, loan, and a liability, deposit. The central bank is not directly involved in this new money creation. Withdrawal by the customer to make a purchase, e.g., buying a house, reduces the bank's reserves and deposits. If the recipient of a payment holds an account at another bank, the original bank's reserves decrease, while the recipient's bank's reserves increase. Liquidity and money supply. Deposits provide liquidity, allowing banks to meet withdrawal demands, but they don't increase available funds. Commercial banks hold reserves at the central bank and government bonds, which are not part of the narrow or broad money supply. Selling bonds can convert them back into money, re-injecting funds into the economy. Government bonds and money supply. When banks purchase government bonds, they exchange liquid funds for bonds, reducing the money supply. If the government spends the money obtained from selling bonds, the money re-enters the economy, keeping the money supply stable. Government borrowing generally reduces money supply as both deposits and reserves are part of the money supply, but bonds are not. Money multiplier concept. The classical money multiplier suggests that banks can lend out multiple times the amount of their reserves, but this view is outdated. In reality, banks do not lend out reserves or deposits directly. The money-creating process is more complex and limited by factors such as interest rates and capital adequacy ratios, not just reserve requirements. Interest rates and lending. Interest rates serve as the pricing system for loans. Higher rates mean higher costs for borrowing. Banks need to maintain a margin between the deposit rate and lending rate to remain profitable. Higher interest rates can limit the demand for loans, affecting the bank's ability to create money. Capital ratio and money creation. Regulatory capital ratios, such as the Core Tier 1 ratio, limit how much money banks can create. The capital ratio is calculated by dividing the bank's capital by its risk-weighted assets. Different types of loans carry different risk weights, influencing how much money banks can create.
Limits on money creation. The capital adequacy ratio acts as a binding limit on money creation.
The traditional money multiplier view does not account for the dynamic nature of banking operations, including borrowing from central banks or other banks to manage liquidity. Deposits and liquidity. Deposit flight and bank stability. Deposit flight, where depositors gradually withdraw funds due to concerns about a bank's stability, can lead to liquidity issues and higher interest rates. Central banks may not always be willing to provide additional liquidity to commercial banks facing deposit flight. If liquidity issues persist, the bank may face forced sale or foreclosure. Impact of excess liquidity. Excess liquidity from foreign deposits increases costs for banks, as interest must be paid on these deposits. Banks may invest excess liquidity in government bonds or issue more loans to cover the costs. The decision depends on deposit interest rates and the state of the economy. Interest rates as determinants of lending. While interest rates influence lending, other factors like bank liquidity, regulatory limits, and borrower creditworthiness are more crucial. Central banks adjust interest rates in response to economic conditions, acting as a cushion rather than a strong determinant of lending volume. Historical context. In the late 1970s and early 1980s, high interest rates reduced bank lending as a measure against inflation. Despite falling interest rates in the 1990s, lending did not increase proportionally, illustrating that interest rates are not the sole determinant of lending behavior. Money creation and regulation. Money creation is regulated by capital adequacy ratios and influenced by interest rates, liquidity conditions, and borrower risk. Deposits, while providing liquidity, do not directly increase available funds or the money supply. The interplay between central banks, commercial banks, and government borrowing significantly impacts the overall money supply and economic stability. 5. Banking and the economy. Bank lending and economic demand. Banks' willingness to lend and people's willingness to borrow create new loans, increasing purchasing power and overall demand in the economy. Increased demand from lending can lead to inflation as more money circulates in the economy.